Hello and welcome to this edition of Closing Trades. Not such a happy start to the trading week or for that matter to the month of November. It's been quite rough this Monday afternoon. The fact that we fell off firstly a good 400 points or over 400 points I should say from the day's peak from where we started off, breached that 24k mark, saw the biggest fall in about a month's time, and then from there we've seen a smidge of a recovery, about 100 odd points play out for the Nifty. Having said that, a good 46 to the ratio of 50 constituents in the Nifty, they still continue to bleed and they're still very much in the red. It's a dismal market breadth at your hands. It's a count of 156 standing to the reds, but just 27 to the greens, and a large cap led fall. You're seeing the likes of Reliance really break the back of the Nifty. It's an over 3% fall that you have on Reliance Industries alone. Then, of course, you've got names like Titan, which is down about 2.5%, Axis Bank, which is lower by 2.25%. And all that cheer post L&T's numbers, the day that the stock shot up about 5 to 6 odd percent post its numbers, that also is currently lower by about 2% as we speak. BEL, ITC, ICICI Bank, it's all bleeding red as we speak right now. In such a critical week as well in terms of news flow, not just the US elections, you've got the jobs data, you've got the FOMC meet, and of course, expectations of China stimulus as well. Amidst that, we're really getting it hard.
You're underperforming the region now, Aisha, and you're underperforming the region, which is point number one. While we are extensively talking about US elections, China stimulus, all the factors which are at play, frankly, that's not having an impact on the global setup per se, which is that if you look at US markets last week, Asian markets, how they have closed, European markets, how they have opened, and how US markets are likely to open, there is no fear per se in terms of where the market is. We had a flat start in selling. I think this could be attributed to one large pivot stock, which is Reliance, which is not going anywhere. No large contribution is coming from banks. So I'm afraid you cannot sugarcoat the market. By the end of this week, hopefully we will get clarity on where the Chinese stimulus would move and the complexion of that stimulus, and then more importantly, who would be the next president of US. So those two factors in a sense are the last two factors which at a global level will, once they are over, the event risk goes behind. So this week, both technically in terms of event, in terms of the magnitude of event, in terms of the positioning of the flows, I think would clearly be one of the most crucial week where you would be really acting and reacting to global mood points and news point rather than local data points.
But Kunal, does it seem like it's going to resurrect anytime soon? Because and more importantly, how significant is a breach of 24k?
I think a significant breach of 24,000 mark for the index. We've fallen below a very critical support, and I think we've retraced the gains from 26th of June somewhere where the index had managed to break past about this 24,000 mark. So it's a very sharp reduction over the last 20-25 days of this sell-off. There are good parts about this market as well as of course the negative parts about the market mood. So for example, on the positive side, we have the likes of Bank Nifty, banking stocks, PSU banking name and the private sector banking name, both of them outperforming or at least showing some signs of resilience when we look at this as an overall pack. The financial services index is the other index which is doing pretty well for itself, and they've been the sole reasons why you're seeing the index stabilizing or getting into any kind of an intraday recovery when you see these kind of sectors trying to participate on the upside. Of course, on the negative side, we've seen the kind of sell-off from the auto pack, from the FMCG names, energy stocks at large. And I think that's one of the major reasons why I would believe that the markets could continue to remain under pressure. So I think something has to turn around for the markets from here on if we are expecting any kind of a recovery. Either there's going to be a short covering wave which could probably creep into these underperforming names, the likes of auto, FMCG, for example, or if there is any kind of a strength and a very large kind of a long built-up formation on these banking names of the financial services pocket, I think only then we can expect a credible recovery. Otherwise, the markets could be a lot more listless.
Deepak Shenoy, on bad global days, we are falling because global markets are down. On good global days, we are not going up. Hello, you there?
I can hear you.
I just saw a shakeout in the screen. Were you there? Were you moving?
No. My phone rang, some spam call. So.
Okay. It must be 18 or guest coordinator. Maybe you're late for the show. Don't worry, Deepak is here. And I can see him on the screen. Okay. Now, my question is that why are we underperforming global markets so subtly? Is it numbers? Is it FI selling? What is the root reason?
I think, Nikunj, we've got some FII selling, so 100,000 crores plus 114,000 crores in the secondary markets last year, last month. So that is just in August alone. Of course, they bought 20,000 crores of Hyundai, so it will appear as 90,000 crores. So that's possibly one reason that's weighing in on markets. It's not a big problem because we're down, what, 7, 8%. We're not even down 10% from the top. Such a big sell would have otherwise realized a lot deeper, market losses earlier. It's also the fact that we've done well last year and the year before that comparatively to the world. So there's some kind of a mean reversion of sorts. Then lastly, the results have not been very exciting this quarter this far. I don't see anything major. I think some on the auto manufacturers also, we saw an increase in maybe one of the four-wheeler manufacturers. The two-wheelers have done reasonably well. Some of the agri commodities and agri inputs have done well. But outside of that, the financials, the even some of the industrials, they're more or less disappointed in terms of returns. So I think that has also played into sentiment. And then you have these big events happening, right? So you've got Iran, Israel, you've got American elections. Once those go past, I think global policy will kind of stabilize. I think that will kind of give us some kind of indication on the way forward. So I don't look this as a major problem. We're only down less than 10% from the top, so I don't think we should be too worried. It's just normal growing pangs.
Have you started shopping in the market?
Yes, finally, some of the stocks we've wanted to buy, they're down 30-40% from the top. So can't reveal too much right now, but we're actually adding more of the names that we've owned very little of in the past because they ran up too much. So we've been able to buy some more defense stocks, rejig some of the defense and the manufacturing portfolio, buy into some. We haven't yet bought into any consumer names meaningfully. But we do have some auto exposure, which has kindly corrected itself a little bit, so that gives us some options. So picking piece by piece, waiting for the rest of the results to come in. After November 15th, when all the results are in, we'll take final calls on a few sectors we want to get into.
Interesting. Kunal, anything on the charts where you think the selling is overdone and could be bought now?
So I think in that sense, maybe there could be a point where few of the auto stocks, and especially I think the likes of Maruti, for example, that stock is showing a lot of stabilization at the 10,900 to 11,000 range where it's trading right now. So that maybe could be the first few names from the auto pack which could make a very strong comeback. There are also some signs that many of the PSU names, and especially the PSU banking lot, they are the ones which are showing consistent recovery on an intraday basis, and especially the likes of SPI, the stock which is trading I think at 810, 820 levels. It's trading above the longer term average, and I think 4-5 days back there was this very strong bullish candlestick pattern for SPI. Post that, the stock has not caved into a selling pressure, but it's been a lot more sideways. But I believe that a breakout of this previous swing resistance could be in for SPI, and adding to the fact many of the other PSU banking names like Bank of Baroda, you're seeing good strength and recovery from the other PSU banking lot, PNB, Canara Bank, even the non-FNO stocks like Bank of India, Bank of Union Bank, etc. These stocks are also showing some signs of strength.
Okay, banks where it is, where it seems like there is inherent strength. But Deepak, what is it that you would not touch in this market, be it on decline and you may have already exited in the past month and a half?
One of the things that we've kind of slowed down or not had too much exposure to is NBFCs for the most part, and definitely not microfinance. I think the numbers that are showing on personal loans in general, so NBFC is exposed to large amounts of personal loans, unsecured personal loans, credit card companies, and there's only one really, so nothing meaningful else there. But also microfinance lenders. The issue is when RBI puts a clamp down on new lending and starts talking to people, first thing that happen is people who are borrowing tend to renew their loans either to the same provider or through a different NBFC. And then when they're not allowed the opportunity to do so because risk weights have gone up and RBI has kind of clamped down on a few of the players, then what happens really is the defaults start piling up. You're seeing that in the numbers. You're seeing everybody talk about stress. So I think that's one sector I'm like carefully avoiding for now. Though I think the larger banks, they have more diversified portfolios and therefore they have more room to operate. So I think they are a better play right now than the NBFCs and microfinance players. But it may soon come to a point where the worst kind of goes behind them, and then they will be priced low enough for you to be able to get into the recovery. So it's an interesting point where I'd say don't buy them now, but they may be coming soon to a point where they're worth buying. The risk is worth the reward.
How would you approach capex stocks now? Because government spending has been low, but the indications which we're getting from the government is that they are committed to spend and they want to pretty much meet the expenditure targets, which means that next 3 to 6 months, big government spending should come out, whether it's road, railway, cement, steel, everyone will benefit. Is there a trade in cyclicals and capex now?
Yeah, it should happen this quarter because I think we were expecting that last quarter it will increase because the budget came in. You got out of the election rut, the election spending because of the election. The first quarter spending was low. The second quarter has been okay. I think we're going to get large amount of spending in the third, and usually in the fourth quarter there isn't much of spending because the government just wants to spend what it has already budgeted. So I think we'll get some accelerated spending in this quarter and perhaps a little more in the next. So we should see most of the industrials, especially those doing capex in that format, will start to improve. What will precede this is some form of credit growth to industrials. That has not really meaningfully happened yet, but I think it's starting to happen. We're seeing early signs of it. So I think we should see an increase in bank credit to the industrial sector. We should start seeing more of these orders flow through in terms of completion, and I think defense capex will take over in the next few months, regardless of what budgets are like because of geopolitical concerns. So regardless, I think that would be a good sector to look at from a capex perspective. Some of them are valued very richly, so you have to be very careful of what you buy. But I think longer term, there's a lot of scope here. Government spending will fuel some part of capex. Private capex has not really meaningfully moved so far, but it's starting to. You're seeing, semiconductor-based capex. We're seeing some bunch of other areas starting to pick up. So think of it as you're watching paint dry. So it will happen slowly. It will happen before we know it, and therefore it's useful to pick up stocks now and kind of ride this through. We have a lot of players in this space, so very biased on capex and infrastructure.
Best play, is it L&T? Is it a road company? Is it railways? Because the word capex means everything.
It does. In fact, I think you'll be good to have an exposure to a lot of things. When you look at core infrastructure, it's roads, ports, airports, they're players in all of them. If you look at infrastructure from a digital perspective, that there also there's a lot of players who are providing services to, say, stock markets, to companies, to insurance companies, and to insurance players and so on. So each of these players actually will do well in different parts of the game. Defense and auto, I think, are primary recipients because they're relatively large employers and contribute in a way to kind of security of the country in terms of self-sufficiency. So they will be in focus of the country no matter what. But either ways, I would say there will be action in this space going forward, because if Trump comes in, there will be tariffs that are placed, counter tariffs on Indian companies. Auto companies benefit a lot from the 100% tariffs we have on foreign imports, for instance. So that might be negotiated or worked around. So there are lots of things in flux, but I think here's where you want a little bit of each of these pies sitting on your book. I don't think I would bet on just one of them, because they will all do well, but at different times in the next few years.
Right, interesting. Okay, Deepak, hold on to that thought. Lots more to chat about with you, but for now we're going to take a very quick break. Let's just revisit what the Nifty level is settling in at. Back at 24,000, but that's only for the Nifty futures. We're still struggling sub that mark for the Nifty spot, although a smidge of a recovery, about 100 odd points from the lows of the day. Continue tracking markets on the other side.
So I have a conversation with our expert. Soni Patnaik also joins us as Assistant Vice President with GM Financial Services. Soni, the market is taking support at key levels in and around 24,000. Do you think we have a trading bottom in place?
Hi, good afternoon, Nikunj. Thank you for having me on your show. See, I think it will be more important to watch the closing for today. If the closing can be above 24,000, then there could be a temporary bottoming out above which Nifty can see a short covering towards 24,200, 24,400 range. So it is very important for Nifty to give a closing above 24,000. Well, right now, what's saving Nifty is mostly the pullback that we can see coming in from Bank Nifty, which has actually held on to its support of 51,000. So there's a high probability for Bank Nifty to hold on to the 51,000 support, and above that, you can see it heading in the range again between 51,000 to 52,000. So as long as Bank Nifty is not breaking below 51,000, there's a possibility that Nifty also may struggle, but 23,800, 23,700 is the immediate support to look for. And any close above 24,000 will give you confirmation of a temporary bottoming out above which we can see some short covering.
Okay, that's the take coming in the index. Just want to mark a couple of movers as well. And M&M amidst the entire auto pack, that's clearly shown leadership today. It's a 2.25% uptick that you're seeing on M&M, reacting perhaps to the monthly sales data. And barring a little bit of a correction that the stock has seen, Kunal, fairly resilient, you would have to say, amidst all the volatility which has happened within the auto pack, M&M that is.
Well, absolutely, yes. And I think it's been one of the standout performers in the leg of correction, as well as in the the previous legs when the markets were doing exceptionally well for themselves. So I think on both counts, the stock has done reasonably well. And so these are the kind of stocks which recovers the first when markets get into any kind of any whiff of a recovery or a start of a an uptrend or a bounce in that sense. So I would probably believe that stocks like M&M are the first ones which generally traders they latch on to whenever there is any expectation of a recovery on the markets. So far, what's also positive for M&M is that the stock is now on the verge of closing above its 50-day moving average. The last time when the stock did this, a couple of months back in the month of August or September first half is where you'd seen the stock moving up from 2,800 levels to almost 3,100, 3,200 plus mark. So expecting the stock to be a lot more stable once it confirms a closing above this 50 DMA.
Deepak, where would you pick and choose within the auto pack? Because now that the Motown report card is out for the month of October, for M&M, of course, both the auto as well as the tractor divisions have done pretty okay. They've seen an uptick of about almost 20%, the auto sales that is total. For Tata Motors as well, the sales are not bad at all. It's versus an expectation of a decline, so an inline set as well would be treated as positive, I'm guessing. For Eicher, of course, they've reported the higher monthly sales ever and an uptick of about almost 31% on a year-on-year basis for Royal Enfield in particular. Hero MotoCorp as well, best ever sales for Dhanteras. For TVS, it's an inline set. For Hyundai, it's an uptick of about almost 2%. Exports, of course, have done much better. And for Ola Electric as well, as surprising as it may be, they've managed to sell about 50,000 odd units in the month of October. Where would you pick and choose within auto, if at all you would be wanting to get exposed to the space or maybe add on to the existing positions?
So Aisha, we've had a considerable position in M&M, so very biased there. But we've been waiting for the two-wheeler pop to happen for a long time. It's finally showing some signs. Even though Hero MotoCorp, which is one of the largest selling here, I think the largest selling two-wheeler manufacturer, still hasn't got back to that 7 lakh vehicles per month level, which we saw, I think, more than 5 years ago. So in that sense, it's been a long recovery. And to a certain extent, the two-wheeler electric manufacturers have come in and taken over the part of that space. So, but I think here, between TVS and Hero MotoCorp and Bajaj, TVS looks the most attractive of them all. I would say, having an exposure in both two-wheeler and four-wheeler, and of course the tractors and this space would actually add a lot of value. Eicher, I guess has been more, premium motorcycles. So we've finally started to see an uptick over there as well. It's taken a while. So I think we might pick up some positions after some time on two-wheelers, but we're maintaining, M&M on the four-wheelers. Haven't done much on CV, haven't done much on tractors. But M&M is a larger play than two-wheelers, so it's or four-wheelers. It's really a multi, pronged play, including defense and a bunch of their holdings in Tech Mahindra and a bunch of other things. So it's a more broadly diversified play than pure this thing. I don't think I touch Tata Motors for now, given the geopolitics. And Maruti's numbers have been very disappointing this month specifically. So not really keen on that stock either.
So this whole talk of a Motown slowdown, is it in the price? Is it something which markets need to price in further? What is your sense there?
So my belief, Nikunj, there is a lot of things that we think are in the price, but when data changes, suddenly you find that it's not. Prices have moved up a lot before any of the fundamentals have. In this last month is when we've seen two-wheeler numbers start to move, but two-wheeler stock prices started to move from 6 months ago. So in that sense, I think the stocks have very high expectations of whatever the numbers are. The Motown slowdown is probably going to result in lower sales going forward because they record the sales to dealerships. Dealerships take loans and put the cars in their own inventory, and the sales are recorded at the manufacturer's end. However, if the inventory buildup is too much, you're going to see that some of this going forward, the sales are going to be lower. If that happens in November and December, then we know that this is a serious problem. Otherwise, if there's actually good sales happening, whatever numbers we're talking about, 79, 80,000 crores, is not meaningfully large. We just look at them as large because they're larger compared to earlier. But our GDP has also grown considerably. So 79,000 crores of inventory across the country is not meaningfully large actually in India's context. We would normally start having that level of inventory if the sales were to pick up meaningfully from here anyways.
Deepak, you track Reliance, the magnifying glass, and this is one position which everybody's asking why. What has changed suddenly in the last 45 days that Reliance has really come under the hammer, so to speak?
So something I think from a slowdown perspective has happened in terms of their retail offering. They've talked about it. Jio has reached a certain level of maturity, and of course you've got a telecom issue with terms of the sales are not rising as much as they used to be, and because they've raised prices, so a lot of people are giving up second or additional connections as well, and you can see that in the telecom data. These are the two big areas. The oil and gas business is largely a business of refining margins, which changes on a regular basis. So that is not really dependable. So that's why maybe there's been a little bit of lower interest in the stock, but I feel there is a lot more potential here. They have a lot more value add inside their businesses than is visible from the outside. So if they were able to at some point demerge the individual businesses, they could all grow independently of each other. I haven't seen any indication of the above happening. It's been 4 years since we started thinking that this will happen. But I think that is what's going to unlock value here and a clearer process of where they move forward. They're doing all the right things. They're setting up data centers, AI technology, hydrogen-based fuel, a lot of new gen technology, which the smaller players aren't really getting into. But I think this is not meaningfully priced in because it's such a large enterprise. These things will add really relatively small value. It's over time that we're going to see all of this come, and I think at some level you need a demerger for these businesses to kind of get valued independently on their own as well.
Yep, waiting for that. Been a long wait and the market has only been talking about it. But Deepak, good chatting with you as always. Thanks for taking the time out. Let's take a very quick break. Still weak. Let's see how the last half an hour of trade this afternoon pans out. Okay, some recovery in place. We're back at the 24K mark, at least on the index. So resurrected above that level. Let's see whether we manage to close on to that and hold on to it up until close. 2.5% roughly higher for M&M. That's clearly shown leadership in an otherwise extremely weak market. There's been TechM and Cipla, which have also held out quite okay. About a 2% gain on both those stocks. But SBI, that's really, been the swing factor for the index today. 1.5% higher for SBI. There's There's Infosys and TCS as well, which have sort of cooled off, or rather, picked up a little bit in trade. You can see quite a bit of recovery in place for all those names. Still under pressure though for a Hero MotoCorp, for Adani Ports, for Bajaj Auto, BPCL, Eicher Motors, Axis Bank. They continue to be still your weak links in trade. Having said that, there's also some other spots of green. I mean, look at a PNB, for instance. Look at what a Federal Bank is doing. Federal Bank, I think, is an all-time peak or a 52-week high. I'll just take it across to Kunal and verify that. Federal Bank at 204 thereabouts has done very well in the recent sell-off in the market. PNB is holding up a good 2.5% in today's trading session, and then SBI, like I pointed out, is also looking good. Kunal, does it seem like the leadership this time, or rather the comeback, may be stronger for PSU Banks?
Yeah, so PSU Banks and few private sector banking names, and I think what we are seeing right now is recovery across the board for PSU banking lot. Now, remember, I think over the last 7-8 months, there was a point where I think in the month of April or May somewhere is where many of the PSU banking stocks had formed a top for themselves. So they were going through this 3-4 month of phase of correction for themselves, irrespective of the market direction at that point of time. Right now, what you're seeing is some resilience which has come back again. There's buying which is witnessed into these PSU banking names, especially the large cap names. So which means that this could be the first sector where we might expect the stocks to get into a recovery. But then I would still believe the likes of ICICI Bank and HDFC Bank at current levels, Federal Bank, the stock which I think today has hit a fresh lifetime high for itself. I think all 3-4 names from the private sector banking names also indicate that the money could be moving back again into these stocks, because these stocks have also shown a lot of resilience in this last 1,000-1,500 point correction for the index. So which means in a nutshell, Bank Nifty and the banking stocks should outperform from current levels.
Okay, banks to bet on. But in the meantime, amidst all the volatility in the market and weakness of late, what are the pockets of opportunity for investors? We posed this question to Ramesh Damani, Nilesh Shah from Envision Capital, Vijay Kedia as well as Sunil Singhania. Hear out their opinion.
One theme that I've been extraordinarily bullish upon is this, what we call digital public infrastructure theme. India has become a digital country. We've almost leapfrogged a generation of bad, poor infrastructure by building a world-class digital infrastructure. So a lot of now companies are now participating in this, whether it's tax identification services, PAN services, ONDC services, or many of those pieces. Then there are maybe half a dozen companies that benefit from this infrastructure play out. So I would first suggest that investors look at this, not necessarily from a 6 months or 1 year or 2 year horizon, but from a 5-10 year horizon. It's a long-term story, and the market caps don't reflect the opportunity that we see in digital public infrastructure. So if you're looking at new investor, looking for new themes, I would suggest you put some money into digital public infrastructure and some pharma companies which have some intellectual property.
I clearly see that markets like China have witnessed that when you go from $3,000 to $10,000 per capita, you're clearly seeing huge amount of spend go up on the BPC side. And if you get the template right, if you have the playbook right out there, I think you could have a potential wealth creator. I mean, we saw these in the 90s where a lot of FMCG companies rode on the basic staples, what we talk as the soaps and the shampoos. It's now, I think that's now a mature category. You now got to move on to the BPC side. And that's where I clearly think there's a very big, powerful mega theme which is likely to emerge in the next 5, 10, 15 years.
I will tell you that I am bullish on Chinese shares. I think that China is the new story. I think China is the new theme. And I think this Chinese stock should do well going forward. For 15 years, they haven't done anything. You just imagine, even Hong Kong index was some 32 or 34,000 in 2008. Yeah, it's still hovering around 22,000 or 20,000 or something. And in 14 years, and we are, I don't know, 8 times plus or 9 times plus, we don't know. So people have written off China. I have already put 2-3% or maybe 2 or 3%.
This whole transition towards renewable, battery storage, which is BAS, and hydrogen and so many other, nuclear is coming back. I think it is very clear that the demand for fossil fuel will not be great, and in fact it might start to peter off, and which would mean that oil structurally seems to be on a downward slope. And I think nothing can be better for India, and I would say that would be the mega theme for India as an economy.
Anand Tandon joins us. Anand, the Indian markets are underperforming. Is this leg of underperformance real? Is it here to stay?
Well, I mean, they have outperformed for a long enough period for us to look out for a few months of underperformance. It has been the best performing market for a longish period without almost without exception. Perhaps only the US was doing better. And consequently, I think it's only time the difference in valuation has grown so high that it is only natural that any international investor will look at other markets. In India too, if you look at domestic investors, I think the level at which we are trading at requires some amount of patience from here on to justify further growth in the market, given the context of the slowdown in the earnings as well.
Gradually, this market is showing signs. I mean, the first port of call that we needed a close above 24,000, and looks like we are here or there, almost there. Will it matter you are at 9870, 9830? No. As long as you're in and around 24,000, that's okay.
1% plus minus swing is what we expect generally on an intraday basis also. So it doesn't matter, 20, 30 points of course is meaningless.
So when do you say that's, I mean, what is that level at which you would say that we are out of danger? 3-4 days of close above 24,000? We are
so I think if we have 3 days close about 24,000 mark, say a midpoint of that last range, we were at 24,000, 24,500 range broadly for the last 1 week when we saw the second leg of recovery or stabilization for the indexes. So if we are expecting a 50% of this range, 24 to 50, if we hit those levels for the Nifty in the next maybe 3, 4, 5 trading sessions, then we can expect a much more stronger short covering wave which could come across for many of the sectors, and especially the underperforming sectors. So I think another 200 points is what we expect, what we want for the index to try and break past about the first level of immediate bearishness, and then is where we gradually believe that there could be a wave of short covering, then there could be sectors and stocks which could start to outperform, as well as you might see some long built up as well as delivery based buying which could happen to these names.
Anand, have you started shopping in this market, or we still are a distance away from the word value?
Well, if you look at how far it has fallen at the index level, we are down about 8-9%. If you look at where the earnings are, we are probably going to see a downgrade of 3-4%. So you have only seen a underperformance vis-a-vis the index of only about 3 or 4%. In a context where the market, which is if you remove the commodity players from the market, most of the stocks are trading at 50 PE. So a growth rate which is really pathetic in terms of single-digit growth for most of the companies, or mild early teen growth. You're looking at 40-50 P. I think there is some more scope for the market to correct before you can start really looking out for stocks to buy.
Sony, anything which is popping up on today's recovery? We are up about 180, 190 points from the day's low, and if this trend continues, we may just close above 24,000. Anything where you are spotting a trade?
So, I mean, I think the only
Just go to Sony. I'm coming back to you, Anand, right after this.
Sure.
Yeah, Sony.
Would be in Federal Bank, which has actually seen a new all-time high today, and it has been sustaining quite strongly above 200 level. There's a lot of put writing that has happened around 200, so one can actually buy Federal Bank at current levels, and on any small decline up to 204, keep a stop loss of 200 and look for higher targets of 215 to 218. So I think this particular stock, which has held on to its support even in today's choppy markets, I think this certainly is showing a lot of strength for further upside.
Right, okay. That's Federal Bank currently in trade. Of course, the stock has hit a life high just today itself in an otherwise bleak market. But Anand, whenever the market does throw up that opportunity, what is it that you're keeping on your radar to buy? I mean, any color that you may have on your shopping list?
Well, clearly if you look at it sectorally, the only sector that has not done very well, more importantly, is not trading very expensive, is actually the financials, and that to the banks. So, that would be one area that you could comfortably look at, despite the fact that there is going to be a slowdown, that the quality of earnings may start to slightly deteriorate, and we've seen the best balance sheet perhaps behind us. But despite that, I think, assuming that we have a reasonable growth in the economy, the kind of deleveraged position that most of the corporates have, I would argue that is still something that you will probably be able to make some money on. And that is certainly a place where valuations are not particularly stretched.
175 points higher for the Nifty, which frankly is not wrong. Anand, what to your mind could be the impact of US elections? for Indian market per se? Could it be knee-jerk, or it could have some volatility in the near term? The swing could be more than 5%.
Well, I think it could be. I mean, see, frankly, it's very difficult to call elections, right? I mean, you don't really know what each individual thinks, and collectively, therefore, especially when the pollsters are also a little confused as to which way to swing. My general, feedback would be that the Democrats are not good for India generally. Republicans are a little better, but we have a volatile president if the Republicans were to win. So either way, you're not you're looking like between the devil and the deep blue sea. It's not that you have too much of a choice. However, it is more likely that there will be more aggressive tariff increases, etc., in the U.S. if the Republicans were to win. And in that context, the exports, etc., may begin to suffer. Of course, it will be targeted more at China and less in India. But already Trump has called out India as being one of the subsidizers and tariff cheaters, as he likes to call it. So it's going to be a little tough. More importantly, the U.S. economy itself is looking a little difficult to navigate from here. Markets are fairly stretched, and therefore I would think that you might see a kind of sell-off there as well. In which event, almost all other markets will also react in sympathy. I can't see how the argument that I'll take money out of US and put it in other markets works very well when the tide is moving out. Also, if you were to look at international investors, right now the preferred place may be places like China and other emerging markets, even South Asian markets or Southeast Asian markets rather than India, given the relative valuation. So I think generally the US market may not be that positive post the election, and the effect of that for India is not likely to be very positive. I'm not going into the economics of it, saying that there will be a weakness for dollar and so on. I think all that is things which will play out over a period of time. I'm just looking at the overall sentiment. I don't see that as positive.
Okay, Anand, stay with us. In fact, we've been speaking with a whole host of experts throughout the day as to what the India-US impact is going to be, who wins the elections, and what's the chatter like. Here are a couple of sound bites.
Until last week, we saw the global markets were really pricing in a Trump trade because the betting markets were heavily tilted in favor of Trump. Now, whether that was because of one or two whales really, putting in a huge amount in favor of a Trump victory, that has obviously been something that the markets have also been considering. But having said that, the markets have been running on with a Trump trade into the last week, higher bond yields, higher US dollar as well. But we have seen a reversal over the weekend a little bit and into the Asian Open this morning as well. And that's particularly because of one of the states, Iowa, which is traditionally a very red-leaning state. That has shown that the polls are really tilting quite significantly in favor of a Harris victory. So this, and we still have 7 swing states to go. This was not even a swing state. So we have a lot of data to come in the next few days. And I think it's going to be a nail-biting week. It does seem like a Republican victory could mean a stronger dollar. You consider, the risks of trade tariffs, that is supportive of a higher dollar. You consider worsening geopolitics potentially, that's positive for a stronger dollar. And just the whole pro-growth, pro-inflation kind of policies, which means that the Fed might have to be a little bit slower on its rate cutting path than previously expected. Again, that's positive for the US dollar as well. But this is a very tactical story. Now, structurally speaking, I know the US could print as much US dollars as it wants to be. But the whole story around, the question around Fed's independence, the question around the US debt, how much debt will they have to issue if they were to consider, those pro-growth policies, those could mean that in the long run, we could see the reserve status of the US dollar being questioned, and that could obviously impact, the strength of the dollar there.
Mr. Trump wins, he will attempt to put a large number of very heavy tariffs. The extent to which he will succeed will depend on congressional support for that. But whatever happens, I think that the mood both of the Democrats and of Trump is protectionist. So either way, it's not a very good outcome as far as India is concerned. I think we are going to find that a number of tariff walls will come up against us. In the past, we have retaliated, which then in some sense complicates the thing even further.
Trump presidency will be mildly more positive for India. There is talk of tariffs, But again, the rhetoric during the election season and the actual action sees a very big comparison. There's a very big difference on how politicians act when they are actually in power. So those 60% tariffs and all are not going to happen. India, I think, is well served by a Republican president. The Wall Street positioning is for a Trump victory.
Maybe there will be a little bit of volatility around the election and post-elections, but I genuinely think at the moment that whoever wins, they have very limited room to create really very different policies, especially in the first quarter. So I highly doubt there will be huge changes. Actually, I think, yes, the dollar might be supported, the yields might be supported, but maybe for different reasons. Given that the US have stronger fundamentals than other, I would say, developed economies.
India has a trade surplus with the US, and the focus of Trump administration is going to be how do you reduce the trade surplus. So yes, I believe that if they go in the direction, when I say they means Trump administration goes in the direction of putting high tariffs, that is going to create some kind of a stress factor early on. But I believe there's enough maturity on both sides to find a viable solution. So geopolitically, the relationship don't get impacted.
Right, okay, let's get in some BTST trades as well while we begin to wind up for the day in a few minutes from now. Sony, let's have your ideas first.
So, I will continue with Federal Bank as one of the BTST trade. And I would like to add another STBT trade over here, which would be a sell recommendation in Astral. Now, Astral has broken down below 1800 level. It's an option chain breakdown. And further breakdown can be seen if futures break below 1730. So one can sell Astral, keeping a stop loss of 1780 and a target of 1680 to 1650 can be seen.
What about your BTST ideas?
So I'll go with the ban Info Edge. That's a chart which is looking attractive. In the morning also mentioned with a target of 7660. Stock seems to have scaled past about those levels. So I think traders could look at a fresh buy. 7880 could be a target for BTST for Info Edge. And stop loss could be kept at 7660 mark. And the second would be a ban Polycab. That's a chart which is looking attractive for a target of 6760. Stop loss at 6440.
Okay, those are some interesting ideas coming our way. In the meantime, let's just revisit what's really the market closing in with, because we're still lower by about 250 odd points. Yes, we've managed to resurrect ourselves above the 24K mark. In fact, 24,100 now for the Nifty futures and above, around that mark for the Nifty spot. But it's been TechM, it's been M&M, SBI, Dr. Reddy's, HCL Technologies, Infosys and TCS, largely technology. That's really been the flavor of the day, and that's really leading the recovery, at least sectorally. And of course, it's been out and out SBI, which has managed to contribute a fair bit to the Nifty recovery. For the broader end of the market, it's been a Dixon Technologies, it's been Naukri, it's been PNB. These are some of the stocks which have managed to hold out. But yeah, sectorally, it's really been technology all through and through. Anand, what's the take on IT now?
Right? I mean, at the end of the day, the managements have started to show that there is some uptake in terms of demand. But look at it. A decade ago, the companies were growing at perhaps twice what they're growing today, and had a valuation of probably half of what it was today. At best, what you're seeing is a base effect where we had a terrible last year, and from there the outlook is looking a little better. Longer term outlook to me remains somewhat bleak for Indian IT services business. Some of the companies are transitioning to products and, more importantly, to specific verticals where they have some expertise. But for the large part, the services business to me seems to have a runway which is looking a little shorter and a little more dangerous, because most of the business that is coming is cost outsourcing. And that cost outsourcing business to me signals that people are trying to get rid of the manpower they have in their companies. If you take what Mr. Sundar Pichai recently said, 25% of the work of programming in Google is now happening through AI. That doesn't bode too well. So I think at this stage, from a defensive point of view, it may be a place where, because it is somewhat less owned, you may find a little more protection if the market were to become weaker. But otherwise, on the upside, I don't think there is too much.
It's 24,000, let me put it this way. And 24,000, we've discussed this with Kunal. Psychologically, in terms of a number, it is important. Momentum, technically also, this is an important number, so to speak. Kunal, so assuming that this is a big volatile trade, US election will be a swing event. It could be gap up, gap down, I don't know, but it would be 2-3% here or there. Then there is the Chinese stimulus. This is a big week in terms of the event per se. And then you got local elections, 20th of November. This is a week, this is a month where you will see a lot of reaction to news. What is the best strategy? Buy out of money call or out of money put? What is a better strategy?
So I think buying a strangle in that sense could be a better strategy. Strangles, when you buy both out of the money call as well as put, and there is a limited downside because to the extent of the premium paid for both of the strikes, whether it's call as well as put combined. So I think that could be a better strategy. What could also aid to the market is the rise in volatility. So I think right now, for example, we are at a point where India VIX today I think hit 17.5 odd levels. So if you manage to sustain even at levels of say 15 to 17 on the India VIX over the next 2-3 days, that could also be a point where the markets could probably tend to get into a volatile kind of a swing, and we could be looking at a swing which could be 2% plus minus this 24,000 mark as well in these kind of sharp event scenarios curtailed into a very short term time frame. So I think in that sense, buying a strangle could be a better strategy.
Right, okay, that's the strategy for the index right now. We're closing in, off from the day's lows definitely, but an Axis Bank, Reliance, there's been Sun Pharma, ONGC, L&T, Titan. These are names which continue to give you weakness, as does ITC, even though it did make some attempts to actually recover, but not quite. Trent, HDFC Bank as well have seen a fair amount of loss coming in. Other than banks, Kunal, some of your heavyweights like an L&T, ONGC, etc. Reliance, of course, we've discussed. Even some of the most fancied names all through this year, like a Trent, for instance. Are they giving you any buy signals, or do you think there is more selling in the stock?
So L&T is one where there is some amount of stability which has come back. So I've looked at this in a manner of the last 1,000 odd points and how the stock characteristics have changed. So for example, from the first leg from 26,000 towards 25,000 mark, L&T and Reliance were the two main large cap names which had taken a lot of beating in that sense, because the stocks had fallen down almost 8 to 10% in that first 4% correction for the index broadly. In the second leg of correction, it's Reliance which has fallen down sharply, but L&T somehow the stock has been retaining this levels of 3480, 3500. So at one point the stock was almost at 30 to 50 levels, but it recovered quite well, and it's now stabilizing at this 3500 mark plus minus 40-50 points for itself. So which means we could be looking at a point where the intensity of selling has been over for L&T, and now the stock is getting back into a stable territory. In these times, I think it's always very crucial to look out for those intraday dips. 1%, 2% correction for a stock like L&T, 50 points down. I think that could be a point where traders could look to buy. So that's one pocket which I would believe that could stand a chance to outperform.
Okay, closing in the market, and optically you look at the screen, red. From the day's low, significantly better. Asian markets, a rub of green. Europe market, not a bad start. 24,000, you can say that bulls have just managed to eke out some gains so that we psychologically close above 24,000. Anand, let's get closing comments from you. What would you not buy in this market despite the fall?
Most of the favorites of the recent move up. So, I would still. So while some of them have corrected, in terms of defense, PSUs and so on, I think they are still perhaps fairly expensively priced. I think what you are really now going to be betting on is not so much, for example, so far we've been seeing the market driven by luxury products, because that's where urban area has been dominant in terms of consumption. I think that's likely to change. So I would not look at urban consumption as a driver going forward. If at all consumption has to pick up, it will be rural, or more importantly, driven by government spending. So it's back to industrials and perhaps rural plays like tractors, etc.
Okay, 2.5 minutes left to go before we wind up for the day. Kunal, let's just get in a strategy for the index and the Nifty Bank for tomorrow. Where do you think we're headed in for?
So I think Bank Nifty is something which traders could look at taking long positions, especially the way many of these large cap PSU as well as the private sector banking stocks have behaved. I would not take too much positions on the index on the benchmark Nifty. as of now. But I think if someone is looking at an option trade over here, for example, then maybe buying 51,300 or to 15,500 call could be a better strategy.
Okay, let's begin winding up for the day. Anand, good to have you on the show. Kunal, we'll let you go on that note as well. And let me hand it over to Ashesha for the closing trades.
Well, yes, after starting somewhat 2081 on a positive note on Friday, it's been a weak start for the markets this week. Nifty ending 300 points lower at that 24,000 odd mark. Nifty Bank also ending the day with a cut of nearly 500 odd points near that 51,200 odd mark. And on account of the fall that we saw on the market, we saw that spike come in on India VIX. Volatility index rose by nearly 6% in today's trading session. Heavyweight Reliance Industries, it did recover from the lowest point of the day, but despite that, ending the day nearly 2.5 to 3% lower. We had that report from agencies which suggested that Reliance Jio could come up with an IPO as early as 2025, and hence the stock did recover from the lowest point of the day. We had select auto stocks which were under pressure. Hero MotoCorp down 4.5%, biggest loser on Nifty 50 index. Bajaj Auto also ending the day nearly 3.5% lower. Apart from that, Nifty Realty Index, the biggest sectoral loser in today's trading session, ending the day with a cut of nearly 3%. We had Brigade Enterprises down 6%, DLF and Phoenix Mills, both of these stocks from Realty Index, also ending the day with a cut of over 4% today. Metals were also under pressure. Hindustan Zinc, biggest loser on Nifty Metal Index, ending the day 4% lower. We also had SAIL, which was seeing cuts of nearly 4% in today's trading session. Nifty Metal Index down 1.5%. IT, of course, was the least impacted sector in today's bloodbath. We had Tech Mahindra, which was up 2%, the biggest loser on Nifty 50 index. And we also had LTI Mindtree, which was holding on to marginal gains in today's trading session. A couple of newsmakers then, Info Edge on account of that Naukri report, which suggested that Naukri jobs peak index rose by about 10% on a year-on-year basis. Info Edge bucking the overall trend, ending the day 3% higher. Sun Pharma Advanced Research, or SPARC as we call it, on account of very good, a weak set of numbers, was down 5%. Revenues were down 39% and margins were also impacted. So a couple of earnings reactions, but all in all, a weak start to the week. Nifty ending near that 24,000 odd mark.